Life Matters, a Penn Mutual podcast for financial professionals, bringing you life insurance insights from advanced sales experts and life insurance specialists. Grow a stronger practice today.
And just last week, for the first time, at least in my career, I don't know, maybe your career too, Tim, the Supreme Court issued a decision which has a pretty substantial impact on life insurance planning in the advanced sales marketplace. It's the Connelly decision. I'm sure by the time everybody listens to this, you'll have at least heard about this decision. I know that we're doing a lot of education on it at Penn Mutual, but for those of our listeners that are saying, what is that? Tim, can you describe what happened last week and kind of what the effect is on both the estate planning and the buy-sell marketplace?
Sure. Connelly was a case that the Supreme Court took up from the Eighth Circuit. The Eighth Circuit is basically the part of the country that runs right up the Mississippi, from Missouri up through Minnesota and then North and South Dakota and Nebraska. And the reason they took the case up was because the Ninth Circuit, which is basically the West Coast, and then the 11th Circuit, which is basically Florida and Alabama and Georgia, had a decision, and these decisions revolve around, if I use a redemption agreement in a corporate context in a closely held business, and basically for simplicity, I'm just going to have the company redeem shares. Well, I've got to fund that because we all know that it is smart sense to fund an obligation with life insurance because you don't know when it's going to occur. So we had all thought for the last 20 years, because of a decision called Blount, which was in the 11th Circuit down in Florida, we had all thought that when you go to value that company for estate tax purposes, federal estate tax purposes, you have to value the company according to the regulations and according to some old revenue rulings. And one of those is, how do you handle life insurance? Well, most people thought that if you have a life insurance policy owned by the company, that yes, the policy has to be taken into consideration in determining the fair market value. But if you have a written redemption agreement that requires the company to use that life insurance death proceeds to purchase the shares and complete the redemption, then it was essentially a wash. No one would pay for cash and no one would pay for a liability. And so you basically washed those two out and you went with the fair market value you did consider the insurance, but it had no impact on raising the value. Well, the IRS and the tax court both thought that was wrong. And the district court in Missouri agreed with that in the Connelly case. And they said, no, you do not take into consideration the redemption agreement because we believe that it has no effect on the actual value of the shares when all the dust settles. And the Eighth Circuit agreed with that. And we just found out last week that the Supreme Court did on a 9-0 decision. So it was a unanimous decision. And Bill, I'm going to not pontificate, and I'm not going to give my critical opinion of this case. What I will say is that going forward, when all the dust settles, redemption agreements funded with life insurance owned by the entity are dead. And what I mean by that is, if you are going to have a redemption agreement and you are going to have the entity own the insurance policy, you're going to end up including that insurance in the value of the company. And the way the IRS looks at it, it's a dollar for dollar increase.
Thank you for watching. If you enjoyed this video, don't forget to hit that subscribe button and turn on notifications so you never miss an update.